Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business podcast. Today, we're going to take a look at the economy, see what's going on. Right now, we're kind of at this bull trap or a false breakout or a dead cat bounce. And then looking at some leading economic indicators, like a third of all people did not pay their rent. So what is the missed mortgages and rents going to do to the environment months or years down the road? We'll briefly touch on the current state of the gold market before we wrap all this up. Even with the expected volatility, Morgan Stanley is spotting something strange about the rally. So they're pointing out that the rally in stocks and the plunge in the VIX or volatility index has been abnormally fast for a country sliding into a deep recession. So that recent bear rally that we saw, there wasn't a lot of buying and not even a lot of short coverings or forced stop outs. And clients actually started re-hedging and adding $2 billion of new short positions. So you would expect to see some covering of a $33 billion net short in futures. That didn't happen. So people are still expecting even more downturn. Whereas when markets are going down, you would see people covering their positions and getting that short squeeze or dead cat bounce. But they're not seeing that happen at all, meaning that they're expecting an even massive or even more of a decline. This has a lot to do with people expecting the worst economic collapse ever. So even with the trillions of dollars to banks, what we're seeing is a lot of banking freezes. A lot of banking services are going to stop funding through the financial markets, and that's going to cease, meaning that the monetary system is likely to collapse even with bailouts. We recently did a podcast about the financial equation that broke Wall Street. And yet we're still seeing that not a single financial model looked at what would happen if revenue stopped. And so as a result, there wasn't a rainy day fund. There was no excess capital beyond a revolver that would only last a few weeks at best. So it looks like they're up to the same thing where whatever equation or financial metric that they're using isn't including, systemic risk. And so we're right back to where we were in 2008. So the stay-at-home orders are going to have long-term consequences, like having 30% of the people not paying rent. According to Bloomberg, there's about $81 billion in commercial rent that is going to come due on average every month. So there's roughly 15 million households, about 30% of mortgage borrowers that missed a payment. So tenants are claiming a force majeure, which is going to be interesting against insurance claims. So acts of God claiming that their contractual obligations are superseded by social distancing decrees. So I'm not really sure. I'm interested to see how this plays out. Landlords are going to try to make the same case to their lenders, claiming that this is all an act of God. So within contracts, they might be able to get out of that. But regardless, there's going to be a huge impact. And I think we're already seeing cracks in commercial real estate with real estate investment trusts. So as these commercial lenders are not paying, these are publicly traded companies that have their own metrics, right? Regardless if it's an act of God, the force majeure or otherwise, whether it's fundamentals, technicals, it doesn't matter. It's a publicly traded company. And so if that domino effect happens where the downgrades start to happen on commercial real estate, the paper markets are going to have an effect in the real world. As commercial real estate comes down, then you're going to start to see residential come down for the same reasons. People aren't making those payments in rent. So we could potentially see an 85% drop in some areas across North America in residential real estate. Commercial real estate could follow that of Japan and drop over 90%. So we're taking a look here at the Buffett indicator, which is a stock market capitalization to GDP ratio. We're in a hyper bubble. So it's starting to come back down into just regular bubble territory. But until it breaks that bubble territory, come down to overvalued, back down to fair valued, back down to undervalued, it's going to have a pendulum swing, right? So we'll hit that undervalued mark eventually, but until we do, this cycle isn't going to break. When it does, I think we're going to see a new currency that's either going to be a gold-backed currency, partially backed gold currency, or a special drawing right. An SDR is a basket of currencies globally. There's about 6 different global currencies that are in there. Visually, the destruction of the dollar is easy to understand. Obviously, when you buy a house in 1950s, your dollar went a lot farther because they didn't print as much. So as the feds keep printing money, it devalues or dilutes current shareholders or dollar holders. currency holders. So this is a currency since 1971. It's been fiat currency, not backed by anything except the full faith and credit of the U.S. government. The government doesn't have faith anymore. People are leaving for other forms of real value, and there is no credit. Credit is debt. So looking at ways of increasing the velocity of money in order to keep the dollar going. That's the only way to keep the dollar relevant. We can see the same scenario in Weimar Germany, where their currency was depreciated, as well as Venezuela, which the U.S. could repeat if we don't have a stop to this endless suppressed business activity. We have supply chain breakdowns, business closures, job losses. All bureaucrats will tell you that they need to restructure the budget and look at the deficits. But what they come to realize is that the velocity of money is the only thing that keeps the dollar relevant. So Obama had to double the amount of money that Bush spent, and Trump has to double the amount of money that Obama spent. And whoever comes after Trump is going to have to do the same thing. The velocity of money is the only thing keeping the dollar relevant. They have to keep printing more of it in order to make it a going concern or stay in business, if you will. Without spending more money, the velocity of money will make the dollar irrelevant, which is just a matter of time. Every single fiat currency eventually reverts to its intrinsic value, which is zero. And normally that's 40 years. The U.S. has held that world's global currency reserve status for a lot longer than most other currencies, and that's already starting to collapse. And so the Bretton Woods system was started in 1971 when the U.S. went to Saudi Arabia and said, settle all dollars being bought for oil, settle those in U.S. dollars, and we'll protect you. So that's been in status for a long time, except when Obama made Iran the head of OPEC. When Obama did that on his way out, that pretty much made Saudi Arabia say, forget it, we're going to sell oil in whatever currency we want, which is a big issue. So if you remember, Saddam Hussein tried to do that and sell oil for euros. He got eliminated. So did Muammar Gaddafi, who wanted to sell a Libyan gold African currency. He got taken out. Venezuela tried to do that. That didn't work out too well. China's been the only one who's been able to get as far as they have. So in terms of reserve currency status, I think when this Rona is over, you're going to find people clamoring for an alternative global currency. So it seems like we've got capitalism in any bull market when things are going good, and then when things are tough, it looks like we've got corporatocracy, corporate bailouts when things are tough on the way down. We're going to see the dollar continue to lose value. This is going to be really painful for inflation. Eventually, the global reserve status is going to be destroyed. But the elites and politicians, they've already got this figured out. So first, we're going to see small businesses get crushed. All assets are going to be absorbed into the banks and major corporations. Second, we're going to see a crash that's going to allow the establishment to test the modern monetary theory. So that, again, that's helicopter money. That's making sure that the velocity of money happens and that corporations get a bailout. As corporations get trillions of dollars, the U.S. is clamoring for $1,200 paychecks. So that universal basic income is going to be breadcrumbs by comparison. We're begging the U.S. government just to give us handouts while these corporations get trillions and trillions of dollars. But the third thing we're going to see is a collapse in the dollar, along with the pandemic opening up the door for implementation of a cashless society. So they're going to claim that dollar notes are dirty when in fact it's just a matter of getting cashless. That's something that they've been wanting for a long time. The advantage of that is that they can follow your every move. So data analytics is important, but also taxing you at every step along the way. So if you want to give your allowance to your kid, that's taxed. Tax and Big Brother, they're going to follow you and know what you're doing. And so everything is going to be monitored. I'm not into fear porn at all. So here's some opportunities. You can look at gold, physical silver, because the ETF markets are 65 times oversubscribed. So there's never going to be a time when you get an ETF and actually get delivered physical gold or silver. It's never going to happen. They're actually closing accounts down that are precious metal based because they just know that there's going to be lawsuits and a disaster to try and deliver on that. So you can see from this graph, there's a disconnect between the US dollar versus fiat and the US dollar versus gold. They've been in line through 2018 and decoupled mid 2018, which means the US dollar is going to plummet. So I'm actually going to go out and buy some physical currency from Canada. It's trading at about $1.40. So that's pretty good. I'm only 3 hours away. I normally wouldn't do that. But if I can use $200 in US and get $300 in Canada, I might as well do that right now, because it's my opinion that the US dollar is going to collapse. Just with every other fiat currency, it's going to go hand in hand. But maybe in the meantime, I can have a nice little arbitrage play, go up and get some toilet paper in Canada or clothing or whatever, just have a good time, in another country like I have in the past. Even during severe economic downturns, there are opportunities. You can see from this Black Swan hedge fund index, they had a total return of 3,600% in March alone. Year to date was 4,144%. Here's another example of a London-based 50-cent fund that made $2.6 billion in markets capitalized. They used a couple of different strategies, including a VIX and a condor. So a condor is one of the most complicated strategies. You can look on the internet and find out. Essentially, it's buying and selling puts and calls, both as a straddle and a spread simultaneously. So what you're hoping for is a lot of volatility, just kind of moving up and down within a range so that it doesn't trigger your straddle or your spread. And so essentially they made $800 million just off the volatility, and then another $1.6 billion off gold and equities and volatility. So again, there are options even in a downward market. So last week, the Feds reported that they're going to buy junk bonds and lend to states to the tune of an additional $2.3 trillion. So this is exceeding legal authority. Supposedly it's temporary, but the fact that they're just going out to the open market and buying junk bonds, not going to be a good thing. Not to get into the weeds too much, but there were no provisions in CARES for this. Neither Section 13.3 nor 14 allow it. And so this is a real-time violation of the law. Yet the Fed is saying that 13.3 gives it authority, but it actually doesn't. So there's a managing partner at the Federal Financial Analytics, which is a Washington research firm, that said that the Fed's steps to create credit allocation are tantamount to a complete redesign of central banking on the fly. It is going to lead to a complete reexamination of the role of central banks and the Fed's independence. Hopefully everybody listening knows that the Federal Reserve is neither federal nor has reserves. And so it should come as no surprise to the listeners that gold is soaring. So in response to that announcement, stocks and junk bonds rose. Gold jumped as high as $1,752. So there is a disconnect between the spot price and physical price. And so as gold is increasing from $1,600 to $1,800, if you were to try and find physical and you found it available for sale on either eBay or a broker, you're going to pay a few $100s more just to get physical if you can find it. I know that silver, for an ounce of silver, between $15 and $17 spot price. Physical is anywhere from $22 to $30 on eBay and other brokers, if you can find it. Eventually, that price is going to be so unaffordable, and that's assuming that you can even find it. So we're starting to see that there is more of a decoupling from spot and physical. You may have heard the recent rumors in the gold market about the availability of physical gold. There's been some social media personalities and news agencies claiming about a shortage, but it's not so much about the shortage of gold, but rather a sudden demand for gold in places where it can't be quickly supplied in the desired form. A lot of that is a new ETF for 400-ounce gold bars, and yet there's not a single one available, not one. There's been a lot of production shut down too. In Switzerland, their mint closed due to coronavirus. So you can assume that once the peak of the panic caused by the coronavirus subsides, that factories are going to open and air traffic normalizes and the gold market is going to return to normal. But I don't think so. You're going to see a lot of sovereign wealth funds, a lot of central bankers, a lot of rich people in the elite are going to gobble this up to the point where we're going to see new all-time highs and the continuation of the deterioration of the dollar as a global reserve currency. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.